banking sector reforms, the government commenced a comprehensive reforms process in the financial system in 1992 to 1993 after recommendations of the CFS in 1991. In December 1997, the government did set up another committee on the banking sector reforms under the chairmanship of M. Narasimhan. The objective of the committee is objectively cleared by the terms of reference it was given while setting up to review the progress of banking sector reforms to date and chart a progress program in financial sector reform necessary to strengthen India's financial system and make it internationally competitive. Okay, the Narasimhan Committee was popularly called the Government of India handed over its report in April 1998. Okay, which included the following major suggestions: need for stronger banking system, for which merger of the PSB and financial institutions were suggested stronger banks and the DFI development financial institution and AIFI to be merged while the weaker and unviable ones to be closed. A three-tier banking structure was suggested after mergers. Tier 1, Tier 2, Tier 3. Tier 1 had to have 2 to 3 banks of international orientation. Tier 2 had to have 8 to 10 banks of international orientation. Tier 3 have to have large number of local banks. The first and second tiers were to take care of the banking needs of the corporate sector of the economy. Higher norms of capital to risk weighted adequacy ratio. Okay, so suggested increase to 10%. Vital recapitalization of the PSB is not viable and should be abandoned. Legal framework of loan recovery should be strengthened. The government passed the Surface Act 2002 need NPA for all banks suggested to be cut down to below 5% by 2000 and 3% by 2002. Rationalization and of branches and staff of the PSB suggested licensing to new private banks, domestic as well as foreign, was suggested to continue with banks. Board should be depolitized under RBI supervision. Board for financial regulation and supervision should be set up for the whole banking, financial and the NBFC in India. DRI, the differential rate of interest is lending programs launched by the government in April 1972, which makes it obligatory upon all the public sector banks in India to lend 1% of the total lending of the proceeding year to the poorest among the poor at an interest rate of 4% per annum. The priority sector lending and all Indian banks have to follow the compulsory target of priority sector lending. Okay, the priority sector in India are at present the sector agriculture, small and medium enterprises. Okay, road and water transport, retail trade, small business, small housing loans. Okay, not more than 10 lakhs. Software industry, self-help groups, agri-processing, small and marginal farmers, additional distressed, urban poor, and indebted non-financial institutional debaters. Besides the SC, ST, and other weaker sections of society, in 2007, the RBI included 5 minorities, Buddhist, Christian, Muslim, Parsis, and sees under the PSL in its new guidelines on March 2015. The RBI added medium enterprise, sanitation, and renewable energy under it. The PSL target must be made by the banks operating in India in the following way. Indian banks need to lend 40% of to the private sector every year. Public sector as well as the private sector banks, both of their total lending. There is a sub-target also. 18% of the total lending must go to agriculture and 10% go to of the total lending of 25% of the private sector lending. Whichever is the higher. Okay, must be lent out to the weaker sections. Other areas of the private sector are to be covered in the left amount, that is the 12% of the total lending. Foreign banks having less than 20 branches, less than 20 branches, okay, have to fulfill only 32% PSL target, which has sub targets for the exports 12%, and small and medium enterprises 10%. It means they need to disperse other areas of the PSL from the remaining 10% of their total lending. Okay, the Committee for Financial Systems had suggested to immediately cut it down to 10% for all banks and completely phasing out of this policy of the betterment of the banking industry and particularly and the economy in general. The committee has also suggested to shuffle the sectors under the PSL every 3 years. Every 3 years, no follow-up have been put on from the government except cutting down PSL target for the foreign banks from 40% to 32%, remaining same for those which have less than 20 branches. Meanwhile, some new areas have been added to the PSL. Non-performing assets. The non-performing assets have the bad loans of the bank. The criteria to identify such assets have been changing over the time. In order to follow international best practices and to ensure transparency, the RBI subscribed to the current policy in 2004. Ended its loan is considered NPA in it. It has not been serviced for one term. 90 days. This is known as 90 days overdue norm. Okay, for agricultural loans, the period is tied with the period of the concerned crops. Okay, ranging from two crop seasons to 1 year overdue norm. NPA were classified into three types: substandard, doubtful, and loss assets. Substandard remaining NPA for less than or equal to 18 months. Doubtful remaining NPA for more than 18 months. Loss assets where the loss has been identified by the bank or internal and external auditors or the RBI inspection, but the amount has not been written off. Rising NPA after the RBI conducted the EQR asset quality review, which was completed in March 2006. The NPA of the banks increased much higher. It was 9.1% of the total loans by September 2006, now double their year ago. Double their year ago level. Equally striking was the concentration of these bad loans. Moreover, more than 80% of the NPA were in the PSB public sector banks, where the NPA ratio had reached almost 12%. Meanwhile, on the corporate side, around 40% of the corporate debt was owed by companies which had an interest coverage ratio less than 1. It means that these companies did not earn enough to pay even the interest on their loans. It means India is suffering from the twin balance sheet. So interest coverage ratio less than 1. Okay, so it means that India is suffering from a twin balance sheet problem, where both the banking and private corporate sectors were under stress. Not just a small amount of stress, but one of the highest degrees of stress in the world at the current level. India's NPA ratio is higher than any other major emerging market except Russia's 9.2%. Higher even than the peak levels seen in Korea, 9.9. Okay, during the East Asian crisis, mid-1990. The main reasons for the unprecedented increase of the NPA of the banks have been as given below. As for various volumes of the economic survey, including that the up to 2016-17 switch over to system-based identification of NPA. Okay, current macroeconomic situation in the country, increased interest rates in the recent past, lower economic growth and aggressive lending by banks in the past, especially during the good times. The RBI come out with the new guidelines to resolve the NPA issue by early 2004. The steps taken under it, our banks have to start acting as soon as a sign of stress is noticed in a borrower's action and not wait for it to become an NPA. Banks to carve out a special category of assets termed special mention accounts, in which early signs of stress are visible. Flexibility through brought in project loans into infrastructure and core industry projects, both existing and new. Non-cooperative borrowers in NPA resolution will have to pay higher interest for any future borrowings. Banks will also be required to make higher provisions for further loans extended to borrowers who are considered to be non-cooperative. Towards strengthening recovery from non-cooperative borrowers, the norms for asset reconstruction companies have been tightened, whereby maximum interest investment in security received should be 15% as against the earlier norm is of 5%. Independent evaluation of large value by restructuring about above reaches 500 crore mandatory if the borrowers intend borrowers interest or principal payment are overdue by more than 60 days. A joint lenders forum to be formed by the bankers for early resolution of stress. That we has set up a central repository of information and large credits to collect, store of the and disseminate credit data of to lenders. For these banks need to furnish credit information on all their borrowers with an exposure of 5 crore and above. Incentives to banks to quickly and collectively agree to a resolution plan. The RBI guidelines announced early 2014 aimed at checking the NP form rising to have not been effective due to one or other reasons as per the economic cycle section 17. And the situation needs a deeper and multi-dimensional analysis. The resolution of the NPA at one hand, while the RBI tried to check the NPA from rising by announcing the new guidelines for the banks. On the other hand, it had also taken several steps to resolve the problem by February 2017. Okay, the RBI has implemented a number of schemes to facilitate resolutions of the NPA problem of the banks. Briefly discussed below. 5.25 refinancing the schemes offered a larger window for revival of the stressed assets in the infrastructure sector and electrical industry. Under this scheme, lenders were allowed to extend the tenure of loans 25 years with the interest rates adjusted every 5 years. So tenure of the loans matched and the long gestation period in the sector. The scheme thus aimed at to improve the credit profile and liquidity positions of borrowers while allowing banks to treat these loans as standard in their balance sheets, reducing provisioning cost against NPAs. However, with amortization spread out over a pretty longer period, this arrangement also means that the loans face a higher interest burden, which they found difficult to repay. Financing banks to expand additional loans called evergreenings. This in turn has aggravated the initial problem. ERC asset reconstruction companies were introduced into India under the Surface Act 2002 as specialists to resolve the burden of the NPA, but the ARC, most privately owned, finding it difficult to resolve the NPA. They purchased today only willing to purchase such loans at low prices. Low prices. As a result, banks have been unwilling to sell them loans. Okay. So asset reconstruction companies. Okay. So here introduced in India Service Act 2002 and a specialist resolved the burden of the NPA, but the ERC most are privately owned, finding it difficult to resolve the NPA. They purchased. So are today only willing to purchase such loans at low prices. As a result, banks have been unwilling to sell them loans on a large scale since 2014. The fee structure of the ERC was modified, requiring ERC to pay a greater proportion of the purchase price upfront in cash or to the banks. Purchase of NPAs by them have slowed down further. Only about 5% total NPA sold into 2014 to 15 and 2016 to 15 to 16. So here SDR strategic debt restructuring. So here in 2015 RBI come up with SDR scheme, provide an opportunity to banks to convert debt of companies whose stressed asset was restructured but which could not finally fulfill the condition attached to such restructuring to 51% equity and sell them to the highest bidders. Ownership change took place in it. By end December 2016, only 2 such sales had materialized. In part because many firms remained financially unviable since July. Since only a small portion of the debt Okay, so here two such marginalized, sorry, here opportunity banks and number of companies whose shares were restructured but which could not finally fulfill the conditions attached to such restructuring to 51% equity and sell them to the highest bidders. Ownership change take place in it. By the end of December 2016, only two such sales had materialized, in part because many firms remained financially unviable since only a small portion of their debt had been converted to equity. Asset quality review resolution of the problem of bad assets requires sound recognitions of such assets. Therefore, the RBI emphasized AQR to verify that banks were assessing loans in lines with RBI loans classification rule. Classification rules. Any deviations from such rules were to be rectified by March 2016. S4 scheme for sustainable structuring and stressed assets introduction in June 2016. In it, an independent agency is hired by the banks which decides as how much of the stressed debt of the company is sustainable. The rest is converted into equity and preference shares. Unlike the SDR arrangement, this involves no change in the ownership of the company. Public sector asset response rehabilitation agency. So next we'll discuss. Okay. So thank you, friends.